Hello, hello. This is Peter Nelson with Nelson Insurance Advisors. And once again, we have the man, the myth, the legend, Logan Hertz from Hazeltine LLC. Logan, how's it going?
Hey, Peter. Good to be here. How you doing?
Doing wonderful, living the dream. And I think we're on part 9 of this whole thing, right?
Yeah, a lot of material is provided for us. We are drawing good out of evil.
Okay. So what do we got going on today?
So I thought we'd go into a little bit of what might have been. Like, what does a real, actual solution look like, right? And so this is not full case design. Of course, I don't have all the details. I haven't gone through everything. So I want to be clear. I'm just kind of presenting a sample, and it's not fully fleshed out, as you'll see. But I think it's important for people to see how we could actually help people. Like, what does a real financial planning process actually look like, right? Um, and so I'm going to present what I put together in terms of a potential solution. Okay. Give me 1 second here, and I'm going to pull this up.
There we go.
Okay. All right. So I have not, again, gone through all of this for sure. It's just, this person is not going to engage with me because he's waiting for his financial advisor to give him permission to do something. So this is sort of a visual depiction of his present position and what the challenges are. Okay. And you can see he really has all of his money in two places. Really, all the money is at risk in the market, right? All of it. He does have some cash and some in an IRA, but it's really everything he has that's liquid is at risk. And it's generating no income, right? So there's first of all, he doesn't have enough to retire, right? That's problem number one, right? And the reason, in my opinion, why he doesn't have enough to retire is because of the current financial advisor he's working with, who hasn't helped him at all, right? It's all chasing after this ephemeral return on investment. Okay.
By the way, when's he going to retire? When he dies, or?
Yeah, he has no plan to retire. I mean, how can he, right? I think he's suffering from a bit of, well, I don't want to psychoanalyze him too much, but he is continuing to work.
And that's fine. I don't want to, I mean, I plan on working until the day I die, but I mean, I don't know, from what I've been hearing the situation, it doesn't particularly sound like if he could retire, he would retire. Am I wrong with saying that?
Yeah, I would like to have options when I'm at his age. It is true that a lot of people who are 75 continue to work, and that's fine.
Yeah, I
But
think it's
usually what they do is they sort of change into a job that's, significantly fewer hours, where they're doing something they enjoy to stay active. They're not working because they have to. That would be the ideal scenario. In this case, I think it's pretty clear he's working because he has to. He's 75 years old. He has a 69-year-old wife who's depending on him, right? He does have grown children, and he has grandchildren. He has, in particular, a special needs granddaughter that he would like to help take care of and leave something for the future. But unfortunately, that doesn't look very likely where he is today. So I think we want to not overlook clearly delineating what the current problem is, right? He has all of his liquid assets at risk, and they're generating no income. Okay. So you can see from the color coding here, it's all at risk. It's all at risk in the market, and it's not giving him any income. Okay. Then his most valuable asset is his home, right? His paid off house. And it's not doing anything for him, right? His current financial advisor doesn't think big picture. It's all about put all your money in jail in the market and hope for the best possible return. And apparently that takes care of everything, right? So that asset is not being utilized. That's more of an opportunity than it is a problem. And then, of course, we have no long-term care protection, no death benefit protection, right? And as I was going through this, what I would like to do is to show, where are you getting your income from in retirement, right? And we could flesh that out and put a list of what are our sources of income and get to the point where we can stack up enough income to retire. That's the way I would do it, not building up a nest egg, but showing income, right? His best source of income today is, of course, his active income. He's a business owner. He's working, generates a modest income. He'll get Social Security, right? We can generate income through an annuity and through properly designed whole life insurance, right? But this is sort of a visual depiction of his current situation, right?
Absolutely. Yep.
Okay.
Sorry, I didn't really have anything to add there to that one, Logan. So just keep on.
Yeah, but I just want to reiterate what his financial advisor says. We see no problems, right? We don't see anything that needs addressing, right? How can you look at this and honestly tell your client, we see nothing wrong, no problem whatsoever? I mean, how can you live with yourself? I don't understand that.
No, I mean, we've talked about this over the 9 parts, I think, is really, this is not, and I won't say this again because you corrected me and I think you're right on this. It's not traditional financial planning. It's this last 20 or 30 years financial planning concept that you should just have all of your money in the market. Like that'll just fix everything. And, you don't need long-term care coverage. You don't need life insurance. You just need to have all of your money in the market. And because, buy and hold and, higher the risk, higher the reward. And it's just a paper loss. It's just buy into that religion and you'll be okay.
Yeah, and the financial advisor likes to tear down everything that he views as competition, but he doesn't offer an alternative ever. It's like, okay, well, what's your plan? What's your framework? There isn't any. There's no written plan. There's nothing. It's just sales and marketing and thinly veiled psychological manipulation. That's all it is. We're actually going to show you a plan, and this is not fully fleshed out, but at least it's giving you a framework. So here's something we're doing first that he's not done. We're summarizing your current position and the challenges associated with it. We've already done a lot more planning than his financial advisor has done, right?
Yeah. And I'll just say one thing in my experience of doing this for 21 years, right now, especially, I mean, the brokerage account has 565,000. In my normal scenario that I run into, that would instead be a 401k or an IRA. So the qualified money would actually be a lot more. But in this situation, for him, it's actually not as bad as most because, of course, the taxes are only going to be due on the gain and not necessarily on the full amount like it would be in an IRA, right?
Yep. Okay, now let's move. So now that we've addressed the current situation, now let's move into some potential solutions, okay? How are we going to address these challenges? Okay, so the first thing we're going to look at is we're going to kill multiple birds with one stone. Now, one thing I have not included in here is an annuity, which we would probably use as part of this solution. But in the interest of keeping things simple for presentation purposes, we're not going to go into that right now. But what we're doing is we're going to strategically move all the money that you have at risk in the market into guaranteed assets where you have no risk. You have a guaranteed rate of return, and it's going to generate passive income. Okay, so again, we're not focused on return on investment. We're focused on generating passive income. Okay, and it's going to give us long-term care and death benefit protection, right? So in this example, we are going to strategically move this into a whole life policy, okay, which has a $50,000 annual premium. So again, just to keep things simple, we would liquidate, right? I'm not suggesting we would necessarily do this, but just for the purposes of simplicity for illustration, we'll just liquidate. So we have effectively, $674,000 that we've removed now from market risk. All that is exposed to market risk today. We're going to remove it from market risk, okay? And then we're going to move $50,000 a year into our whole life policy. We would probably also strategically use some kind of an annuity, but we're not going to show that here. Okay, so that frees up immediately $589,000 worth of liquidity. Okay, again, the money in your brokerage account, right? The dollar amount there, it's not really liquid until you make it liquid, right? It could disappear, right? It could go down significantly if there's a market correction, right? We want to remove that from market risk and turn it into a source of income. So as soon as we pay that first premium into the whole life policy, we get a permanent $617,000 death benefit, okay? That gives us both death benefit and long-term care protection. And I should have also mentioned legacy, right? That's a permanent death benefit. So it's going to be passed on, okay? And again, if this were a fully fleshed out plan where I really went into the details, we would probably also use some form of an annuity to turn that nest egg into a form of guaranteed income that we could use partially for living expenses and partially to fund the whole life policy, which will then give us even more income in the long run, right?
Absolutely. Keep on going, Logan. You're doing good. I'm just working. I'm actually on my part that I'm going to do. I'm actually working something up on the back end here. So keep on going. It's looking good.
So this is a lot of numbers, I know, but this is just a little more detail on the whole life policy. And again, it's hard to look at this in isolation, but I want to show how this works. So you can see here, it's showing a $50,000 annual premium, which by the way is not required. That premium payment is not a liability, okay? When we pay that first $50,000 premium payment in, we have a permanent $617,000 death benefit, okay? We also have $21,000 in cash value. So we can immediately use this $21,000 if we wanted to. So what I want to point out is in year one, your out-of-pocket outlay is not $50,000. It's actually this number right here, this negative number, $28,000. Because you pay that $50,000 in, but you immediately have $21,000 available to you. So it's like you bought something for $50,000 and then you got a $21,000 mail-in rebate. Right?
Absolutely.
That's how that works. And if we were to borrow out this full $21,000 via a policy loan, it still keeps earning for us inside the policy. Okay. And a policy loan is not a debt. There are no repayment terms on that whatsoever. So it's functionally the same as a withdrawal, except that it allows us to keep earning on everything that's in the policy. And again, I can design this policy so many different ways. Okay. So I don't want anyone to conclude that this is the solution. This is a potential solution. We could get very creative with case design. Okay. So you just started a self-completing plan to save up $617,000. Now notice every time we make a premium payment, the death benefit goes up, right? That death benefit keeps growing. So if we fast forward as an example to year 10, all of a sudden we have over $1 million in death benefit. And that's assuming this company continues to pay the lowest dividend it's ever paid in its entire recorded history for the entire life of the policy. So what we're showing here is the worst case scenario. We're not making the sort of wildly unrealistic assumptions that his financial advisor is somehow allowed to make, assuming we're going to get 12% return every year, right? Well, we all know that's not going to happen. There will be down years. We know that's not going to happen. So this scenario we're showing is the worst case scenario, in my opinion. Okay. And of course, we have guarantees. We cannot have a down year. The cash value will go up every single year. You will have a positive rate of return. The only question is how much. This $617,000 death benefit can also be used for long-term care. Okay. And let's fast forward to year 4. So in year 4, you pay that same $50,000 premium and your cash value grows immediately by $51,000. So Peter, if I give you a magic bank account where every dollar you deposit into your bank account results in $1.05 of account balance growth immediately, how many times are you going to make that deposit?
I'm going to keep on making it.
As many times as possible, right? As many times as possible. So once we hit year 4, this is why asking what a whole life policy costs is such a misguided question. What are you talking about? If I give you a magic bank account where you deposit $1 and your account balance grows immediately by more than $1, That's not really a cost, is it? Right?
Nope.
Okay. You could pay in that $50,000 and immediately borrow out a $50,000 policy loan. Meanwhile, the full cash value, which in this case is over $160,000, keeps earning for you inside the policy. Right? So this is, by year 4, we reach what Brent Kessler calls the broken vending machine dilemma. Okay. In year 1, we have a properly functioning vending machine. You pay your dollar into the vending machine, you get your Coca-Cola. But you don't get your dollar back, you got your Coca-Cola. That's the death benefit. Okay. Fast forward to year 4, you put your dollar in, you get a larger Coca-Cola because that death benefit has grown. And the machine spits $1.05 back at you. The machine's broken, right? You got more out of it than what you put into it. Why would you not want to make that premium payment, Peter? Please explain this to me.
Hey, I know one thing. I got a bunch of money going into this type of stuff as well, so I believe in it.
So that death benefit by year 4 has grown from $617,000 to $735,000. So more than $100,000 worth of permanent death benefit growth, which can be used for long-term care, and of course will go to your heirs.
So Logan,
I want to go back up, and I just want to point out one thing. Remember, this $565 in the brokerage account. Okay, if we're really getting the double-digit returns, like this financial advisor is being so dishonest and talking out of both sides of his mouth. Okay, Mr. Financial Advisor, if we're really getting 10% returns, we should have no problem funding this whole life policy. That means we will have an additional $56,000 in this brokerage account, right? This brokerage account will be spitting out more than $50,000 worth of gains every year. So, hey, we should be able to use that brokerage account to fund the policy for this entire life of the policy. Meanwhile, this brokerage account will still be more, right? Because it's probably growing by more than 10% is what he's promising, right? If we can really peel off cash, like you're saying, Mr. Financial Advisor, what's the problem? Well, the problem is he knows that's not going to happen. He's being dishonest, and he wants to keep all the money locked up in jail. He's never going to give his client permission to use any of that because he's holding out the phantom promise of larger gains. And the reason why the client goes along with it is because the client is in the unfortunate position where he's desperate enough. He needs to get those double-digit returns. And so he's throwing good money after bad because he needs these returns that are, I hope it works out. Like, I hope they materialize. But yeah, money in a brokerage account doesn't solve for anything. So sorry, Peter, go ahead. I know you're going to say something.
Oh, no, I just wanted to mention, Logan, if you could pull up yep. Okay. So what I love looking at something, after 10 years, 20 years, 30 years, but I'm just looking. So he put in 500,000. We got all of our cash back, and yet we got $1 million death benefit now. So here's my question to you. Doesn't that mean that he could technically spend most or all of that money while he was alive? And then the minute that he died, wouldn't the death benefit actually replenish all the money they used while he was alive? So the people that took care of him, they could be taken care of as well. Is that what you're telling me with that illustration?
Yeah, and it gets way better than that. But yes, it's such a great point, Peter, right? Because the financial advisor is focused on the cash value, which is important, no question, missing the death benefit, right? It's like saying you have $1 million home and your current acquisition is 500,000, but the minute you die, you get the full million, right? It wouldn't really be accurate to say I have a $500,000 asset. No, you don't. You have $1 million asset. It's $1 million house, right? It's $1 million house. And you can keep borrowing against that house without interrupting the growth in the value of the house. And this happens to also be in a rental property where you're collecting rental income, right? Same exact thing here, right? So what I like to tell people is when you look at the cash value you have in here, so what you're talking about, Peter, is year 10, you have $528,000 worth of cash value. You can mentally double that amount.
Right.
Why do I say that? Why do I say that? Because these are dollars you can use twice. If you have $528,000 in a brokerage account, you're going to be afraid to spend it, right? Because then that money stops earning for you as soon as you withdraw it, right? Here, you can borrow that full amount via a policy loan, take out, let's say, $500,000 via a policy loan, and use it however you want. Meanwhile, this full $528,000 of cash value keeps earning interest and dividends for you, and the death benefit keeps growing as well. It's analogous to borrowing against your house, except there's no debt. You can get 95% of the equity, right? There's no repayment terms, okay? And there's no market risk. This house is guaranteed to go up every single year. So yeah, the numbers on the page cannot illustrate what a phenomenal tool this is. And it gets better every single year. Look at year 11. Now the premium amount goes down. In year 11, you pay in a $26,000 premium. Your cash value grows by $47,000 immediately. No market risk, no taxation. Why would you not pay that premium, Peter?
Absolutely.
Let's say you wanted to do what this financial advisor wants you to do and take that $26,000 and put it in the market. Well, here's what you do. Take that $26,000, pay it as a premium into your whole life policy, then immediately take out a policy loan for $26,000 and you have $26,000 now working for you in the market, and you have an additional $46,000 working for you inside the policy. And if that market investment goes down, you haven't lost anything because you first permanently locked that money inside your whole life policy. And then when you die, this $1 million death benefit pays out.
Yeah. You know what else I'm seeing?
Going into this, it's not a cost, okay?
Right.
And it's not locked up in jail. It's freeing up your capital.
I'm looking at year 16. This is another thing I like to mention. I like to compare this in a way to, you know how in 401ks there's you put in $1, the company will match up to X amount, whether it be 3% or 6% or whatever, right?
Mm-hmm, mm-hmm.
So in this scenario, you're going to put in a premium of $26,349. Let's go over here to change in total cash value of $52,719. So starting at year 16, for every dollar I put in, are you telling me that I'm going to get another tax-free dollar contributed by the insurance company?
Yeah, and it's actually better than that too. Because again, what do you actually have? A almost $1.2 million death benefit, right? That's what you actually have. So this is a self-completing plan, right? A self-completing plan. So
wow.
Yeah.
I'm getting a dollar for dollar match at year 16 on this policy. And yet, quote unquote fiduciaries like this like to talk about how this is not a good deal. I honestly don't know how anyone would not want a non-correlated asset class like that in your portfolio. I just can't understand it.
Yeah. And he doesn't understand what it is because like we talked about before, it's not an either or scenario, right? Right. Hey man, if you want to take, like we said, year 16, let's say you have 26,000, you're like, you know what? My financial advisor is telling me the market's going to go up 15%. I want to put all of that in the market. I can't fund a whole life policy. Yes, you can. Take that 26,000, pay it as a premium into your policy, okay? First, before you do anything. Now your cash value grows by $52,000 immediately. Now take out a $26,000 policy loan and go and put that money in the market. Now your money is earning for you in the market. And for every dollar you have in the market, $2 is earning for you inside your whole life policy. So if the market investment works out, great. Now you're in an even better position. You got that double-digit return in the market, and you got returns in your whole life policy, and you have that growing death benefit protection, and you have long-term care protection. It's not an either-or scenario. You can do both with the same dollar. It's not like you have to earmark these dollars for investing and these dollars for whole life. No. Take those dollars, run it through your whole life policy, and then put it into whatever you want. So if I were whiteboarding, what I'd show is today your present situation is you have your income, okay? It comes into your bank account before you do anything with it. Then you spend it, you save it, or you invest it. One of those three things, okay? The problem is when you do that, all that money leaves your checking account, right? There's an opportunity cost to doing all that. Okay. Now what we're going to do instead is we're going to pay a premium into our whole life policy. Now that money's earning for us. If we want to spend it, we take out a policy loan and spend it. If we want to invest it, we take out a policy loan and finance the invest. And if we want to save it, we just leave that cash value untapped in the policy where it's earning a competitive interest rate guaranteed, right? Now, none of that money ever left our personal economy. The money we spent, the money we invested, it's still earning for us inside the policy, right? This is how you pay yourself first, as they say. Pay yourself first. The way you do that is you pay a premium into your specially designed whole life insurance policy. Now that money is permanently captured inside your personal economy where it earns tax-free for you from now until the day you die. And oh, by the way, if you die tomorrow, that death benefit pays out.
My goodness. Sometimes I do this for a living and sometimes I still look at the numbers and I'm like, I just want to buy more like tomorrow. Like I got to buy more of this.
Yeah, I don't understand. Well, I do understand. There's a lot of psychological manipulation going on, right? As to why people wouldn't do this. And the more I look at whole life insurance, I'm like, this is way too good. This can't possibly be true. And I have to dig under it and kind of remind myself, okay, yeah, actuarial math. Yep, it works, right? Because guess what, Peter? Math is really powerful if you can get it working in your favor. The problem is most of us use the conventional banking system and Wall Street vehicles where math works in their favor. And we're so used to that, we just accept all these limitations without realizing it, right? We just accept that we have to take on all this risk in order to grow our wealth. We just accept that we can only use every dollar once. That's what most people think. If you have a dollar, you can only use it once. You spend it, you save it, or you invest it, and then that's it. It did one thing for you. False. That's not what rich people do. It's called velocity of money. What rich people do is not seek for a higher return on investment, okay? Because whether you get an 8 or a 9% return on your savings doesn't make a big difference in the long run. But if you can take that same dollar and put it to work for you multiple times rather than just once, now you're really getting ahead. You're creating cash flow.
Yeah.
Okay. So that is the first part of the solution. Okay. We've already gone into way more depth than his financial advisor ever did. Okay. Now let's look at the next part of the solution. By the way, again, we're leaving out some things like annuities. If I fully flesh this out, we'd have some more things in it. But
and by the way, in regards to that, I do have something worked up. I don't think we're going to get to it today, but we can next part 10, we can I wouldn't mind going over the annuity side, Logan, and just kind of showing them how that would work, if that's okay with you.
Yeah, and the annuities are so powerful. Again, like whole life, like annuities, when you situate it in your overall financial picture and understand the job that it's doing for you, right? If you just think of everything in terms of return on investment, then everything looks bad, right? Except for money in the market where that rate of return is just based on an assumption. Nothing's guaranteed, right? So once we understand what we're trying to accomplish and we situate it in our overall picture, then you see how powerful annuities can be, especially in retirement, right? Okay. So this is, again, a big opportunity to me. Like, if you're a financial advisor, how can you not look at this, right? His financial advisor never even mentioned a reverse mortgage. I doubt his financial advisor even knows what the guy's house is worth. I don't think he went through a very detailed discovery process on, hey, what are you actually trying to accomplish? What's your current assets? Nope, it just give me all your money. All right.
Well, I mean, we would hope, I know I'm required to, there's a suitability that I have to take him through. So I would hope that he knows this stuff, but you never know. And
yeah, well, right. And even worse if he does, because then you have all that information and you're not using it, right? So what does a reverse mortgage do for you? Here you've got a paid off $615,000 house, right? This is worth more than all the money you have in the brokerage account, okay? If you did a reverse mortgage, you would immediately have you've immediately freed up $212,000 worth of liquidity, right? That's huge. You can see, if you remember from his previous position, he doesn't have a lot of liquidity. He doesn't really have a cash position, right? Because he's making the mistake of trying to squeeze the highest return out of everything, which means throw everything in the market as soon as possible, right? So here we would have a $212,000 growing line of credit, which can be used to generate tax-free income. We also have guarantees, right? So again, we're de-risking. No matter what happens to the value of your house, that reverse mortgage can't be canceled or go down, right? It goes up.
Yeah.
Okay.
And I'm just curious, Logan, because I get asked this question all the time. Whose name is on the title yet?
Whose name is what?
Whose name is on the title yet? People think that the minute that they go into a reverse mortgage, that they're no longer on the title of the property, but the client themselves is still titled on that property, correct?
Absolutely. This is a non-recourse loan. You could pull that full $212,000 worth of credit and never make a single repayment. No problem. No problem.
So as Don Graves likes to say, IJAM, it's just a mortgage, right?
Yeah, but it's much more than that, right? Because a standard mortgage, you got to make payments on it. Here you don't. There are no required payments.
Right.
No required payments.
Yeah, I just like to mention that because I've never in my entire career mentioned the words reversed mortgage, and all of a sudden people's attitudes, it's like when I'm deer hunting, and all of a sudden the deer smells you a little bit, and all of a sudden the deer gets all, like knows something's wrong. That's what happens to people when I mention reverse mortgage. They're like, oh. I'm like, it's okay. I've never seen such a reaction to anything else. I don't know if you've ever seen that before as well.
Yeah, well, try mentioning whole life insurance.
I don't get I've seen people maybe, but not like reverse mortgages.
Okay. Yeah, Don
just,
Graves said in my interview, mentioning a reverse mortgage is a good way to get stabbed at a dinner party.
it's true. That's why I think I only mention it going forward on Zoom calls so they can actually stab me,
Yeah, yeah.
But
well, and then again, here's a little more detail on this. Again, I just want to point out, with both the whole life policy and with the reverse mortgage, we're showing you how it's going to perform without market risk and without taxes, right? First of all, this particular financial advisor probably didn't show him a whole bunch of numbers, I'm guessing. And if he did, it's all based on an assumption. We're just going to assume some market rate of return, right? Well, then what are those numbers worth, right? Here we can actually show you with a reasonable degree of certainty how it's going to perform, and it cannot go down, right? So here you can see the line of credit starts at about $212,000. By year 10, it's grown to $436,000. Again, no risk. The happens to the value of your home, right? If the market crashes, doesn't matter. Okay. So you can access all of that if you want to. You can also turn it into a 10-year payment. So this 10-year payment shows you can basically annuitize it if you wanted to, where you could get paid, let's say if in year 10, you want to just turn on the income, you'd get then $3,300 worth of basically tax-free monthly income as long as you live, right? So again, we have guarantees. We have guarantees.
I'm looking at that. You know what I'm thinking? That's a heck of a parachute in case of a long-term care event in the future. Look at like year 85, $673,000 there.
Yeah.
Wow.
And, I'm not a huge fan of having a lot of money in the market at 75, but if you did, this would also allow you to ride out some of those downturns, right?
Right, because it's also a buffered asset, right?
Right. And that's what's so great about this and the whole life policy is if you all of a sudden need a chunk of change, it doesn't interrupt your plan at all. If you have $500,000 in the market like he does, and all of a sudden you have a long-term care event, you have a cancer diagnosis, something, you need 50,000, which happens, especially at his age, right? Now you're in trouble. Now you got to withdraw 50,000. And now your plan is interrupted, right? You don't get those gains. Whatever the market does, you miss out on it with that 50,000. Here, your plan is not ever interrupted in the slightest. Take 50,000 from that line of credit, it keeps growing. Take 50,000 via a policy loan from your whole life policy, it keeps right on trucking. No interruption.
Yeah. Now, I think what a lot of people get confused of too is, well, the minute I die, the bank gets the house, and that's not entirely true. It depends on. It's no different than any other. If you have a mortgage on a house, right, or something else, that let's say if they end up using $100,000 of this loan, and the house is worth at that point 600,000, wouldn't that mean that the family would get the difference, which would be 500,000 if they sold it?
Correct. Correct.
Huh. So what you're telling me is that that big myth about reverse mortgages, that they're the boogeyman, the bank instantly gets to keep the house, that's entirely false.
It's entirely false. It's entirely false.
Interesting.
You do hear about people losing their houses who got reverse mortgages, but usually it's because they didn't pay their taxes,
And
not
wouldn't
because
they?
they're reverse mortgage, right? Reverse mortgage doesn't mean you don't have to pay property taxes. It doesn't mean you don't have to maintain the house. It doesn't mean you don't have to pay your HOA fees, right? You
But
still have those costs associated with home ownership, but those are that you're going to be paying those anyway, right?
yeah, and if you don't pay your property taxes, aren't you going to lose the house anyways?
Exactly. Exactly. Yeah. This is a non-recourse loan, right?
Yeah.
So with both the whole life policy and the reverse mortgage, there's no market risk. We're not paying any taxes on any of the benefits we receive. And we can use the liquidity without interrupting the growth in the asset. When you think about those three things together, I mean, it's just so powerful. So powerful.
And I'll even add to that, Logan, if when we talk about the annuity, actually the annuity does the same thing. Right? You're protected from the downside risk. You also have a wellness benefit to help offset a long-term care event. You can participate in the upswings without the downswings, blah, blah, blah. So all three of these, have amazing
Well,
benefits.
no. So the difference within annuity is you cannot use those dollars twice. Annuities are great. When you purchase an annuity, you're getting a guaranteed income stream. Phenomenal. And you can't outlive it.
Well, I'm referring to but I'm not talking about annuitizing it though.
But an annuity, you can't borrow against an annuity.
No, you can't borrow. I want to be clear about that, but I just meant that you still have you're guaranteed to not lose any money from the market risk. Yes, you don't have leverage dollars, but you're still protected from that. And
an annuity is taxable. There are some tax benefits to annuities, but it is taxable. Whereas both the reverse mortgage and the whole life policy, none of those benefits are taxed. Not the cash value, not the line of credit you're using, not the death benefit, not long-term care. If you advance yourself a portion of that death benefit for long-term care, right? It goes up regardless of what the market is doing. And when you utilize the liquidity in your whole life policy or in your reverse mortgage, you don't interrupt the growth in that asset. So the cash value and the death benefit in your whole life policy keep growing even while you're using it. The line of credit in your reverse mortgage keeps growing even while you're using it, right?
Yep. That's a good point. Yep.
So it's much more powerful than what's illustrated here. But also, again, with the numbers here, we're not making ridiculous assumptions like we're going to average 12% in the market, and we can't have a down year. There's not the same level of risk. So
Logan,
that kind of is what I wanted to share, just to show people, another way of approaching this, right? And to show people we have a framework, we have a disciplined approach. It's not just sales and marketing, right? And I think my viewers, the people who are smart enough to be watching this channel, can tell the difference between what's just basically sales collateral versus an actual framework, an actual solution and financial planning process. Which again, this is me doing this without really going through the full process, right? Just based on the limited information that I have.
Right. And
you can see how we've clearly identified the problems and we put him in a much better situation without taking any money away from him. Just utilizing what he already has.
Right. I mean, absolutely. All right. Well, Logan, that was great. And I think we're going to do at least one more part of this. And I'm looking forward to talking about what I like to reference with the Ernst & Young report and the new 60/40 portfolio, as I like to call it. And I'm going to talk about annuity. And if you have anything else for the next part, but I think that was really good. I think you went over two really key things there, talking about a whole life policy and talking about a reverse mortgage. Two things that anybody can, whether they integrate one of them or both of them, can really make their portfolio more effective and efficient.
Yeah, and they're it's the more you think about them, the more amazing they are. It's just, yeah, I can't believe, people. I can't believe people aren't doing this, more of them, but I know why. It's unfortunately psychological reasons, among
Yeah,
others.
and remember, folks, all we're talking about here is we're just talking about moving money from your left pocket over to your right pocket. It's still
Right.
in it's still in your pants pocket, right? So it's not like it's just left pocket to right pocket. But the only difference is now this right pocket has some special features built into it, right? So in a nutshell, that's all we're talking about here. This is nothing crazy, actually, believe it or not.
Yeah, very true, Peter. I love that analogy of moving money from your left pocket to your right pocket. When you lock your money up in jail in a market account or a retirement account, you're locking your money up in jail. And so people are they're very defensive, understandably, because they're like, well, what if I need that money? Wait a minute, I have to like actually earmark and set aside money for this, right? Which is true. But with the assets we're talking about, you don't have to earmark or set aside anything. You're just moving money from your left pocket to your right pocket. That's all you're doing. You're not locking anything up in jail. You're doing the opposite. You're freeing up more liquidity in the process, right?
Yeah, free the hostages, as I like to say, free the hostages. So, all right, Logan. Well, that was great. Thank you for another wonderful one of these episodes, and I look forward to next week. We'll hit double digits here, number 10. So, well, thank you everyone for listening in. And if you have any questions or you want to potentially sit down with me or Logan and put together, talk about some of these things that we talked about today, reach out to us. So, Logan, you have a great rest of the week. God bless and Godspeed.
Thank you so much, Peter. God bless.